All right, YouTube, I'm extremely proud to bring to you today the interview with the one and only OG Wyckoff Pro, Bruce Fraser. Hope you enjoy. Yeah, Bruce, why don't you go ahead and just say your introductions, where you came from, how you got started, a little background.
Well, uh, first of all, everybody, thanks for having me here. This is fantastic. And you know, I spent 27 years as a professor at Golden Gate University in San Francisco, which had the only technical analysis program, I like to say, in the known universe. And we started with one class. Dr. Pruden, who hired me and started teaching the first class in the mid 70s. And then I took his classes, absolutely fell in love with the topic, which is all technical analysis. And uh, eventually, long story short, he ultimately, after I finished graduate school, started my career, and everything was moving along, he hired me to start teaching his technical analysis course, which was a survey course
Hmm.
on all things technical analysis, which I absolutely loved. And I did that for a number of years. And then he and I decided that we were going to start a Wyckoff course.
Hmm.
And so we did a one semester Wyckoff graduate course. And Golden Gate University is an accredited university, a small private school. And then ultimately we expanded the whole program. The Wyckoff course became 3 courses, and then we expanded the whole technical analysis program where a person could actually get a certificate taking graduate courses and apply those courses towards their MBA finance degree. And
Okay.
so, yeah, so it just went on and on like that. We did it for a very long time. And I guess I started doing this about 40 years ago. And so it's great that I can still talk about it. So anyway, so that's in a nutshell. We can go any direction from that you want. And
Sure. Well,
uh,
here's one I bet everyone wants to know. How did you first get your exposure to Wyckoff? Like there's a million principles out there. I like to say it's like a million different types of martial arts. Everyone's got their favorite. Everyone's got their dojo. But where did the
yeah,
Wyckoff come to play for you?
well, I was a graduate student and I was a finance major, and my instructor in one of my finance courses said to me after class one night, he says, "You got to take this course from Dr. Pruden." And it's absolutely fantastic. It's not for everybody. Technical analysis is a uh, kind of a controversial approach to financial markets, but I think you're really going to like it. And so I knew nothing about technical analysis. Little maybe kind of an unknown thing about me is that I came out of the horse racing industry. So that's my background. And so I thought I was going to graduate school to actually be able to secure, because I was ambitious. I wanted to do well, but I was going to graduate school getting a finance degree so that I could then maybe achieve higher heights in management in horse racing. Didn't know where, didn't know how, but that was my original intention. And then I took Dr. Pruden's class, and certainly the finest teacher that I ever had, and took his class as I was advised. And I think it was by the 3rd class that I'd absolutely made up my mind that this is what I was going to do the rest of my life. And uh, I knew right away. And up to that point, I didn't know anything really about stocks. The only stock I owned was the stock in the racetrack I worked at. And that was the extent of it. And I knew more about handicapping and horse racing than I did about the stock market. But that ultimately served to help me in the future. But then the other part of it was that Dr. Pruden, as part of the survey course on all things technical analysis, which included, all the basic indicators, but also GAN and Elliott wave is that the sort of the core of Dr. Prudent's approach was the Wyckoff method. And so I just became enamored with it. And I just thought it was just a mastery level beyond just doing chart analysis. Now, I absolutely love all things charting. I love indicators. I'm a junkie for all this stuff. But I am a pure technician. And at my heart and soul, I'm a Wyckoffian. And so anyway, that's how it started for me. Then I went on. I asked Dr. Prudent to sponsor me when I was doing my graduate thesis, and we came up with a graduate thesis together. And I did that when I finished up graduate school. He sponsored me. We got it published. And so that was a big deal. And I was off to the races, and so to speak, in my industry.
Interesting.
And then I went into finance. Ultimately became a principal and a partner in a couple of investment advisory firms. Two of my partners were absolutely the most brilliant people you'd ever want to meet. And they were Martin Pring. Many of you know Martin, who has been a dear friend for, 35, 40 years. And then Joe Turner. And Joe is probably the best business cycle analyst. And I would put Martin right there too, that I've ever encountered.
Did they know Wyckoff?
Not so much, I would say. I'm sure that both of them were familiar with the Wyckoff method, but it wasn't at the core and the heart of what they did. As a matter of fact, I tend to call Martin the father of econometric technical analysis.
Oh.
Because he turned around, he took he wrote Technical Analysis Explained, which is a classic. I know many of you have it. And that he took that and took those concepts and built them into a whole methodology for how to be able to evaluate time, the business cycle, and the markets that really rotate around the business cycle. And so I basically was steeped in that from the very early part of my career because of both of my partners, who were so incredibly had such wisdom and knowledge about it. So very fortunate.
That's awesome. Great background. I appreciate you sharing that. I I gotta tell you, because I think you would laugh at this. Somebody in the chat said, or rather, they asked if you used Wyckoff on horses, and that's how secretly you got rich in life, was identifying accumulation on who to bet on, that kind of thing.
Well, there's a lot of principles. It's actually a very good comment. Very good. I'm not sure it's a question, but one thing, because I had the great good fortune of being around horse racing since I was a child. And that was my dad's business. So the first time he took me to the track, I just fell in love with the whole phenomenon of it, the feel of it, the people, all the different aspects of it. And then when I was old enough to work, which was like really before I was 10, I started doing jobs at the track for my dad. And that worked into a real job that I did all the way through, growing up, preteen, teen, college, all that. I went to the horse racing scholarship program. That's how I got through college. And so
that's great.
But some of the aspects, and I won't bore you with the details, but some of the aspects of handicapping that were so relevant to the stock market are things like relative strength, relative performance of a horse, for instance, and a horse demonstrating improved relative strength with its most recent performances. So there's a relative strength aspect. Okay. There's also an aspect of bet sizing. And there are ways to be able to, through the way you structure your bets, to be able to manage and control risk. And so all of those were elements of handicapping that I learned I had the great good fortune of getting to know some of the really great handicappers in the country. And it's basically because I was sort of a nosy kid. You know, they just couldn't say no to me. I'd ask them, you know, I was one of those kids that just would ask, you know, 50 questions and then they'd go, you know, shut up, kid. You know, it's
Get
like,
out of here.
I'm busy.
Yeah.
But no, I kind of knew when to back off. But I really adored these people and I just hung around them. Sometimes it's just hang around and watch and you'd learn stuff from them. You know, you wouldn't even have to ask questions. You just pay attention. And so I had some of that benefit. But anyway, I learned a lot about being very careful, being patient. Very best handicapper that I knew, really a brilliant gentleman. He would handicap every single race in the racing form every day, all week long, all month long. And only on those rare occasions when he saw a situation where he thought that the probabilities were in his favor and that the horse was paying a really good price, which is a concept of valuation, because he was basically gambling or betting on a horse where the odds were mispriced. The odds were better. The horse was better than the odds that they had at the time. And so there's a valuation metric, and then there's a relative performance metric. And then there's the comparing a horse to the other horses in the field, which might have an industry group characteristic, and being able to compare, you know, individual stocks against each other in an industry group or a sector, say, things like that.
That's
and so
fascinating.
there were all these things, and they really, you know, as I studied financial markets, I always wanted to take it back to a lesson that I learned in my earlier days at the tracks. And I loved to handicap, but I wasn't a big gambler. And I didn't really have time. I was a hard worker, and but I sure loved being there. But the other part of it that I became fascinated was probability, studying probabilities. And so as a kid, I would go out and buy books on probability theory. You know, it's like, you know, I'm sitting there, understood about a third of what I was reading, but eventually I started to, you know, understand the math well enough that I could, you know, really understand the concepts of probabilities in horse racing, which ultimately served me well in financial markets. And one of the things I learned as a kid, which was very valuable to me, was that what they called the VIG, which is the take of the house from every dollar bet, is so large at a racetrack that you could be the best handicapper in the world and you could break even time after time after time, and you're beating the odds because the VIG is so high.
Okay.
And so once I learned that, and then you look at the financial markets and you realize that there's always a VIG in every transaction you ever do anywhere, but that it's substantially less in the financial markets. So you can create an edge in the financial markets much more easily than you can in, say, going to a casino or going to the racetrack, et cetera. And I became mathematically aware of that as a young man, as a boy. And that really cured me of wanting to play the horses. I still love to handicap them because I like the analytical aspects of it. But
Sure.
really, that was one of the most important things that I learned.
Interesting. Okay. Good background. So chat wants to know, is that, let's say, the house's take, for lack of a better word, would you view that as something like the composite operator? I mean, are these concepts similar in a way?
Yeah, I would say that's a very good question. Love that question. And so one of the things, I mean, the composite operator is very shrewd, very smart. I like to say that they're not doing anything illegal. I mean, I'm sure that that's, you know, that there is inevitably the possibility of that, but I like to think of them as just being really, really good operators, and that they are managing and moving such large sums of money like a Warren Buffett, that they have to pick their times really carefully, when they accumulate, when they add, when they distribute, and so on. And so they're in a position where they can choose when and how they engage in the markets. And that's very important to being a composite operator. It's very important to being a handicapper, because you get to pick the races that you want to bet on. And my dear friend, who was the really great handicapper, if he bet on one race in a week, often he didn't even do that, but he handicapped them all. And he knew every trainer, owner, horse. He had their past performances in his head, and so on and so forth. But the thing about the house is the house has always got to show up.
Yeah.
And that would be like the market maker on the floor of the stock exchange in the old days, you know, the New York Stock Exchange. This guy right here is, I call him, it says Wall Street. This was a picture of the 1907 crash. And so you can see Mr. Wall Street here with his feet in the Epsom salts, and he's got the elixirs, and he's got the ice block on his head, and it's been really, really rough. And but see, these are like the market makers that have to show up no matter what kind of market it is. They just got to be there. And so they got to make markets, whether the markets are gently going up, whether they're aggressively going up, whether they're crashing. They got to show up and do that. That's a little bit like maybe more like the horse racing metaphor.
Okay, and I do just want to like point of clarification here, both for me and probably for the listening audience. So we have the composite operator. This is the the largest entity or collection of entities, but you can think of them as like one supermassive entity making moves on the chart, like you said, a Warren Buffett type. And then a market maker. Now, traditionally, a market maker is somebody that it trades on multiple exchanges and helps drop the percentage differences and kind of bring everything to a par, give or take some slight percentages. Is this kind of the same idea?
Yeah, so I'll describe it in sort of the old way, because now that it's all electronic, it's a little different.
Right.
But in the old days, they would be the people that were standing on the floor of the New York Stock Exchange, and the orders would come in, big orders, small orders, and then they would match off buy orders and sell orders, and they would take a spread.
Yes.
And the spread was adjustable, and it was based a lot on the liquidity in the system. There'd be a lot of times when there'd be a mismatch of orders. Sell orders in a panic are going to way over engulf the buy orders. And so that's what causes a market to go down violently, for instance. And so they have to stand in there, because if you put an order in, you want to know your order is going to get filled. And so that market maker's got to make a market, and they've got to give you a price where you can clear your trade, where you don't get to choose what the spread is. The spread is a function of the way the markets are trading. And the spread, hopefully, is what allows the market maker on the floor to be able to make a profit, or to be able to not lose a lot of money, because sometimes they lose money because they got to be there.
Right.
So if RCA, which is a stock that traded way back when, RCA, a huge order would come in and there wasn't enough buyers, the market maker would have to buy that stock onto their own book. And then hopefully they'd be able to sell that inventory that they just took into their book of business and be able to break even or make some money. And so the market makers were really a valuable function. That's different from a composite operator, because a composite operator is we called it a heuristic. And so it's maybe another way to think of it is it's a useful fiction, because composite operators are a collection of people that tend to do the right things at the right times, and they tend to do them at the same time. So they're buying stocks in an accumulation structure. They're selling stocks in a distribution structure. They have comparable values in terms of when a stock is cheap and when it's expensive. and so on. And they can show up and trade the market. Like we would make the case in now that distribution occurred in 2021 and 22, and that distribution literally was the selling by, sorry for this fuzzy chart, but up here, this is the distribution phase.
Mm-hmm.
And this is where the composite operator types are raising cash, selling stock, and they generally will hold cash all the way through until they get into another area where literally the CO is the one that defines the support. Correct. Because they are systematically starting to buy at a price. And so they're buying at a price and they're building their position, and they are running such large portfolios that it could take a Warren Buffett months to be able to build a position that was adequate to the size of his portfolio without moving the market. Because the one thing a CO does not want to do is to drive the market up against their campaign. And so they're not going to willy-nilly buy stock and drive prices up when they have to buy so much. So they tend to buy carefully. They tend to buy on weakness and as best they can. And then eventually what happens is that you see, let's see, is what you see, let's get all these lines on here.
Fancy.
Is, yeah. And so you see here that this phenomenon, what is it that drives prices into a new uptrend? It's what's called absorption, because the composition of who owns a stock over here is completely different from who owns the stock over here. And that's the thing you can't see in the stock charts. So in the stock charts, you see bars, you see volume, and so on. But what we as Wyckoffians are looking for is we're looking for the footprints of the large informed interests, which we call the composite operator. We look for the signs of their absorption of shares. And what happens is oftentimes when a trend starts to go up, is that it actually comes with diminishing volume characteristics. Well, how is that possible? Because we all learn that, you know, stocks will tend to have high volume as they're going up. It takes volume to drive prices up, and that's, you know, that is true. But the thing that's happening is this, the three laws. One of the laws is effort and result. And when you have a big move up, and it doesn't take a huge amount of volume to drive prices up, that's a large result with minimum effort. That is evidence of stock having been absorbed, and it's in strong hands. And so what it would take for a composite operator after they've accumulated their line of stock over here in this accumulation, the only thing that, and I would ask this question of the class, what would it take for the CO to then sell their stock? Well, the only thing that will get them to sell their stock is much higher prices. And the CO, they can't afford to just trade around the trend. They build a position and they're there, they're in. They're going to hold on until they feel that they have maximized the benefit of that ownership over time, which is a much higher trend.
Bruce, I gotta say, I love these conversations because this is, you got to imagine, I'm trying to get this concept across to people who want to trade Dogecoin and other silly named coins that I can't repeat because my mother's already disappointed in me. So there's stuff out there that, like, conceptually you want to get these ideas across, and it's hard to do sometimes. So I've had to come up with different ways, like, you know, during accumulation, essentially, you think of one billionaire takes a billion people with $1. You know what I mean? Like there's this transition. And so some of the things we like to build both in real time, so for example, the Dow Jones over the last, by the end of last year, you kind of matched up what is the news saying? Is the news telling you to be like excited and ready for another leg up, or is the news telling you to be fearful? And oftentimes it's the complete opposite. And I personally, and I could never prove this, right? But I think it goes beyond just oh, people were just euphoric and they were silly, and that the CEO took that opportunity to sell right there. I think it goes to the point of these CEOs and CEO types actually pay the news. Like, hey, I'm gonna slide you a little money, run a ad on how great NFTs are, and then he quietly exits his NFT position, for example, that kind of thing. But that's me with my tinfoil hat on. But conceptually, yeah, these are everybody in the chat. This is how a market works. A market is done going down when the CEO says it's done going down, and it will only stop going up when he's tired of it going up. So this is something that I want to do with any stock. Now, Bruce, just as a little background on me, I'm a buy side spot trader only. Unless I see the world's best setup, and typically it's the end of accumulation. After a run of the lows, after some consolidation at the highs, and off we go. That's my setup. That's my sweet spot. So I have to be very patient, very like for years. And we saw Ethereum do that. We saw ADA do that. We saw a number of these crypto coins. And back when I started my journey in 2020, I didn't even know to look for this kind of thing in traditional markets. I only knew that it happened at Bitcoin. Like that's how juvenile and green and beginner I was. So it wasn't until late 2020 into 2021 that I even kind of like zoomed out and started looking at the traditional markets. What's gold doing? And that's something I think we could come back to later on in the show, because I do want to get your thoughts on it. But that's just the for instance, what's gold doing now? What are metals doing? What's oil doing? What are interest rates doing? How does the Fed play into this? So I think over the last year and a half, I've really kind of expanded what I've looked at. But behind it all has been this one model you're showing right here, and I love it. So I was kind of geeking out just hearing you talk about it because I love it. Okay, continue.
well, hey, I think of myself as a continuum, and I'll look back on the prior year. Like I said, I've been doing this forever, and is that I'm always trying to learn new things, and then I'll look back on it and I'll go, am I any better now than I was a year ago at doing this? And I really try to be able to answer that question, yes. And I have to honestly say, it's the difficult markets that are the ones where you learn. And so I've always had my greatest positive lessons in the markets where there's been like a big primary downtrend, and I've been through a bunch of them, and you get through those and you survive them. And what we all have to do, and I used to teach a course on strategy and implementation, which we talked a lot about methods, styles, and like Wyckoff is a methodology, and there's a whole lot of aspects to it. It's a mastery method, but there are many of them. There are a number of them. And so one thing that we taught in that class was we taught different styles or methodologies. And then how do you know that you have a sound decision-making process? And are you following your decision-making process? And we literally, the whole class was devoted to this concept. And the most important thing is that you want to focus on this philosophy. You want to make sure you're psychologically prepared to execute on your rules and do the work. And you're always looking for improvement. It's always it's constant improvement all the time. And so this was a very important experience for me. Now it's many years ago, but to teach that class. And I had a number of professionals come in, talk about how they did what they did and so on. we had COs, and my advice to everyone, and this is something that I did personally, I still do it, and that is collaborate, find people. Zoom, you have Zoom now. You can, we didn't have any of that stuff. We had a piece of paper and handmade charts. I couldn't even afford a computer to make charts. I mean, when I started out, computers barely would make charts. I mean, it was a rare thing. And so you have this wonderful opportunity to find like-minded friends and collaborate with them. Get on Zoom, do an hour a week. I literally have multiple sessions with very long-term old friends, students, peers that I do these sessions with, and we mostly do them on Zoom now. And we're still, working on developing our skill sets. And believe me, if you get on there and you start, like do a Wyckoff analysis, we use the case study method to teach. That means our students had to come to the classroom prepared to offer a case study on their current market of interest and what they were, and be able to analyze it from a Wyckoffian perspective, do the vertical charts, do the point figure charts, be able to talk about the different attributes of the method, and do this with each other, just like meet and get online and share screens and do this analysis, and then ask and really beg your collaborators to give you, feedback and advice about what they're seeing, and teach each other, literally be sounding boards for each other. So I really, if there's one thing I could stress tonight, it's to do that. And I did that all through my life. I had at Golden Gate University, we had the great good fortune of having all these phenomenal, great people come through Golden Gate, give lectures, come to class. I mean, people that became personal friends. Joe Granville, I mean, many of you, you're probably all too young to remember him, but one of the great technicians of all time, brilliant mind, absolutely brilliant mind. He was the guru's guru in the 50s and 60s as newsletter writers. Bob Prechter would come and he would talk about Elliott Wave. And we have people like Justin Mamus that went on and on and on. These people would just come right through.
I love it.
And it was unbelievable. And but there's an opportunity. There's a great the San Francisco Technical Analysis Society, TSAASF.org, is an organization that I belong to, and that was where a lot of my collaboration came from. Now, we used to actually physically meet in San Francisco, have meetings, have these great people come speak to us, but we also now we do a lot of online things, and we have a worldwide presence of members. It's very inexpensive to be a member. We're gonna have a fall conference. We're gonna stream it for people that are not nearby, and so we try to do things very, very inexpensively, and share these great learning experiences. But find a technical society that you can belong to, get involved, volunteer to do work, and that's what I did. I was like, I'll do anything, just put me in, coach. And so and that's how I got to know all these people. And so do that. For those of you that might be overseas, International Federation of Technical Analysts, IFTA.org, it is a collaboration of 20 societies around the world, all of them not for profit, with the same like-mindedness. Go check them out, find one that's in your region, and look into being a member and get involved. So those are things that I think are really important.
That's great. That's great. I love it. I have this kind of dream of building a fund and stacking it with Wyckoff backed analysts and just sicking them on the market. Okay, you look at crypto, you look at stocks, you look at energy, you look at currencies, ready, go. Just find the setup, go. and having them kind of scour the internet. And kind of related to that, I know some people would say, "Oh, we'll just program a bot, program a some kind of machine to go look for that thing." And to that, I would share an experience that happened to me last year, actually in 2021, right when there was very clear signs of distribution for Bitcoin. Right, this is in the crypto side of things. For Bitcoin specifically, I talked to an individual who was very, very loud, proud, showed up on CNN, every interview you could think of. And he was certain that we were going to go over $100,000 for Bitcoin. Right. And it was more than this is what he hoped happened. It was certainty. I have the model to show it, and here's what's going to happen. And in these private messages, the two of us spoke, and I brought up Wyckoff, and I said, well, look, let me explain, just hear my side of it, and then you can kind of factor that in and see what you think. And his response at the end of it was, I cannot program Wyckoff into my machines. Therefore, it's voodoo and witchcraft, and I will never believe it. And what's funny is he is gone from the scene, and the Wyckoff folks are still here because this was very clear signs of distribution going on both in crypto and the traditional markets. And so we're not sitting around waiting for every headline. And I think you would most likely agree that there's a large group of people that seem to just pull up CNN or Fox or CNBC or whoever first thing in the morning. What's the news? What's the news? And as though that has a bigger impact than the structure on the charts. And I'm sure you are, and I'm going to let you say whether you feel this way or not. But I know, speaking for myself, I am 100% charts, like not 90, not 95, but 100% charts over news.
Yeah. Well, same here. I do like to look, I do have this conceptual structure of the business cycle in my head that, is there just because of the nature of our business. And so, but I am at my heart and soul a chartist, a technician, and then most importantly, a Wyckoffian. And but I would say this, I mean, I'm getting a little philosophical here, but I'll just say this one thing. And that is that all of us, let's just commit to each other right now that we are the whole key in this business is to be the last woman, the last man standing at the bottom, is to be a survivor.
Yeah.
To be there at the end, because there's a lot of people that jump into this business. I've seen it so many times, people that make just a pile of money on the way up. And they really develop a good methodology for like a momentum market, which tends to be the last phase of a bull, actually. But they're really good at it, but they're nowhere to be found at the bottom of the bear. Mm-hmm. And so let's just be committed. Nobody gets out of a bear market in one piece. Every market has a bear market, but the key is to get out of it mostly whole, be able to come around, learn all you can during the bear market. That's one of the benefits you get from the down markets, is it gives you time to learn and study and read and pay attention and do charts and just be very, very risk management oriented. It's the people that are risk management oriented in the bear markets that are the ones that keep compounding money every bull cycle. Now, admittedly, most of my cycles are behind me, but my expectation is that I'm going to do, like, I've got a zillion more to do, and so, I mean, they're going to have to take me out here kicking and screaming. But the key is, yeah, so it's like, but let's all commit right now to that philosophy. Yeah. Because believe me, I've been around, I've known so many people, I know so many of the greats that I've had the great good fortune of being able to have drinks with or talk to or make friends, etc. And to a person, they're all survivors. And if you learn how to be a survivor, you learn how to compound money. And there it is.
That's the name of the game.
Yes.
I put a tweet out I guess it was May or June of last year, because I was thinking of what you were talking about, of just what you
Hmm.
were saying, and the I think the way I put it was, making money in a bull market is easy. The hard part's not giving it all back, something to that effect.
Exactly.
And
And
just
more. And
right,
more.
right, exactly.
Yes.
Especially you introduce margin to it, and
Yes.
things get even worse. So I see you pulled
I
up.
can tell you some horrific stories, which I won't. But I mean, it's not just what bull markets do to infect people in trading, but it infects people. Like my career is a stockbroker, and then I had many clients down in Silicon Valley. Not after I became a portfolio manager, investment advisor, and they were all just really brilliant people, and but I did know of people, and I'm not sure I had anybody in any of my clients, but that they couldn't bear the thought of giving up any of their shares in their high tech, you
Right.
know, uh, company that they were working in, and they were worth like a gazillion dollars on paper. And then what they do is they go out and um, instead of selling shares and like buying a house or building a new house or whatever in their chosen neighborhood, whatever, they would borrow money against their stocks.
Leverage it. Yeah.
And and I saw numerous stories, and I used to save them. I keep them in a file of people that did that ended up because they borrowed money against their stock to build their dream house, that they end up getting a margin call, effectively because they can't meet the mortgage. And
Yeah.
the broker says, well, you got to pay off this loan. And I've seen bull markets do that, infect us in many, many different ways as an economy. And so again, be a survivor. A book that I want everybody to read is a very old book. I think it was written in maybe 1911. Reminiscences of a Stock Operator,
Mm.
which was written by Jesse Livermore with Edwin Lefèvre. And this is a book that for many years I'd read it every year. And there's so much wisdom in that book. And so we would require, it was required reading in our classes. And so I really encourage you. It's very well written. It's wonderful stories, and every kind of imaginable financial market story that you can imagine and how it would affect a trader is in there. And they're very illuminating. So
I love it. I love it.
yeah.
And to your point there, it reminds me that there was a conversation I saw. It was just a video clip, and I saw it maybe a year or two back, but it was actually with Warren Buffett, and they asked him some personal question about what's the worst loss he knew, or something to that effect. It was essentially saying, what have you seen along the way, that kind of thing. And he opened up and he shared that he actually had a partner, um, in the very, very early days, but that partner wanted to grow faster and, go to the moon, so to speak. Wanted to make money quicker, do things, with a little more risk. And he ended up completely flopping out. He lost his money and he got out of the markets. And he was a partner with Warren in those days. And he could be right there with them to this day and be, one of the wealthiest folks around, but he got impatient. And so something you said earlier was basically doing the psychological prep. And something we talk about on this stream a lot is preparing like a boxer or a fighter, and having the coach kind of talk to you before the fight, and we do that a lot mentally to prepare for worst case scenarios more than best case scenarios, just because that's where you can kind of lose it all. But we like to do that a lot, even in the good times. Bitcoin's at 30,000, Dow Jones at 36,000. Let's talk worst case. What if this is distribution? Where's our targets? That kind of stuff. And to be honest, and to be completely transparent, your name comes up all the time within those discussions, because there's a very select few groups of people who will even look for distribution, It's hard, like I was telling you before the stream, that how you're a diamond in the rough here, and that's largely because it's hard to find someone who is just net neutral and is just reading the chart and doesn't get caught up in the hype, doesn't try to get the soundbite in on CNN, but actually just speaks with honesty and truth. And here's what I think's happening. And I think you're that person. So I guess all that to
Well,
say thank you for being here, and
oh,
I'm still geeking out a little bit that you're here. I love it.
well, and I think about us all like I thought about my students, which came from all over the world. We have students that would move uh, from Asia to take our courses. And I had a guy one time that commuted every week from Toronto to San Francisco to take our class for a semester. And people would, and we had people from Europe, we had people from Asia, all over, and they were super hardworking, devoted people. Made it so much fun. But it didn't matter whether you were local or where you were from. But let's just all look out for each other and just get out there and do the best we can, support each other. That's the reason I write my blogs, which I slowed down there because I do more videos. But go to stockcharts.com, go to articles, read my blogs. Those are all designed to, basically teach different concepts at basic, intermediate levels and some advanced on Wyckoff, and go through and look at, I do the case study method. So it's all case studies, more or less. And just study those charts, talk to your friends about them, try to find examples on your own, and so on. And, one day you're just going to go, I have students come to me and say, Professor, I just can't see it. I can't see the structure. And I'm having so much trouble. And then I say, just don't worry about it. Just don't give up. Just keep at it. And, eventually you'll pick it up over time.
It'll click.
And then one day they come to me and they go, I can see it.
Mm-hmm.
And I had that happen so many times.
Yeah.
And so like here, for instance, at Bitcoin, and I know that a number of you are doing Bitcoin, but like here, you can see the distribution structure here. So you can see like here all through this area, and you can see preliminary supply, buying climax, automatic reaction, secondary test, sign of weakness, and then a last point of supply. There it all is pretty straightforward. And so, but this goes to the point, really one of your earlier stories, is this wasn't the final high. And so what in fact did happen here, because it was a subtext, it was a story within a bigger structure. And so here is, if you look here, the blue lowercase labeling is what we just saw there. And then you can see the larger in black cap letters. That's just my interpretation of the structure that we have. And this is through, I guess, today. Yeah. And so you can see there the characteristics of a larger distribution. So this one over here on the daily chart is pretty substantial looking. And in fact, look what it did. I mean, this was a more important decline. So it was a part-whole relationship. It was fractal. And then it went down. You always draw resistance at your buying climax, draw support at your automatic reaction. You could have done that in this little structure too. And then look at how it contained the distributional characteristics thereafter as we saw the unfolding of this distribution. And also, I just want to point out just something that I like, and that is, this is relative strength of Bitcoin of all things to the S&P 500.
Ooh.
And I think this is like a little something that I like to do.
Interesting.
And I think that pretty much every investment has to be able, for portfolio managers, has to be able, and you got to think like a portfolio manager. You got to think about what they're thinking about. And that is that here, they're always asking, well, is this underperforming or outperforming the S&P? Because that's their bogey. I know that's not the case for all managers, but for many, that's the case. And so you look here, look at how you have this base forming in the relative strength. I look for Wyckoff basing structures in relative strength. And I learned this from a portfolio manager who started his firm, very famous firm, can't tell you what it is, but he became a mentor of mine, and he did everything off relative strength analysis. And he said, oh, he told me he started in the 30s. He actually invested money, family money, as a young man in 1933 at the lows, and then became a manager in the 40s and 50s and was like one of the best in the nation. And he really just ground into me the importance of relative strength. And so I just, I look at it for everything. But notice this accumulation structure here along here, and then up it goes. Well, there's the outperformance. So now you're starting to get interest and attention by more than just your crypto world.
Right.
You're starting to get interest from the institutional side, maybe. And maybe it's hedgies that can do things in the Bitcoin space or whatever. And then look here, notice this little test of this area. Look at the distribution that you have. You could do this on a daily basis. You can see it right there. But look, this is a lower high. Relative strength's making a lower high against a higher high in Bitcoin. Upside non-confirmation there in that upthrust.
Yeah.
And so that's like an early warning clue that it's starting to lose its mojo, its luster to the S&P. And then look at where all the trouble really starts. It starts when it gets below the long-term moving average. This is a 39 week, but you can use others. There's no magic in that. And then here, look at this rally up, touches the underside, breaks the moving average, touches the underside, and then it starts to go down in earnest. And so this is where all the trouble starts, and the relative strength is failing.
So let me ask you something real quick with that image you have on the screen. This is something, as I said earlier, I'm relatively new to seeing distribution patterns in real time. So I was actually asked by the chat, your left image there, the one that's more zoomed out and it's over, 6 months or whatever the time frame is there. And I was asked, hey, could this be distribution? And I remember saying something to the effect of, it could be, because if I had a cookie cutter mold and I like put it up to the page, it would fit. Like essentially, I get it. But I have never seen a 6 month long distribution, and the implication of that scares me. If we go back and we look on, say, the dailies, 2017 Bitcoin topped, and there was actually a really nice distribution pattern within the top of Bitcoin, but it wasn't, it was very quick, right? It was compacted. It was 30 days, something like that. So, and then on the tail end of it, it took 4 months at the bottom after spending a year even getting there. So the implication of a 6 month distribution really scared the crap out of me. So all that being said, what is your take on a massive lengthy distribution, and what are the implications we can take away from that?
Well, first of all, distribution, let's talk a little bit philosophically here. Let's go here. So here is a schematic for distribution. Mm-hmm. Go to my blog page at Stock Charts, and you can go in here, just go into the archives and go by date. So just go into that date. You can get these, you can read the article, and then you can print the article, which a lot of people do, or you can just paste these up. I literally, for years and years, kept these distribution schematics on my wall. And I just think about them all the time relative to everything I was looking at, including my lunch. I'd look at my lunch, I go, it looks like distribution.
No, I do it too. I know what you're talking about. He's not joking,
yeah,
Chad. I see it everywhere.
Yeah. It's like technical analysis is a metaphor for life. Anyway, so the whole key to these structures, this one is different from this one, but emphasis is, this is not pattern recognition like a head and shoulders top or broadening formation or any of those things that you see in the book. And I have nothing against those. That's what I learned first. I learned all that before I learned any of this. Here, we're looking for characteristics. We're looking for attributes of price and volume. And you see here, there's a characteristic to a buying climax. There's a characteristic to an automatic reaction. There's characteristics that occur as you go from the left side of distribution to the right side. And so are constantly on the lookout for these attributes that tell us, they show us the metaphorical footsteps of the composite operator showing up and distributing their stock very stealthily, very carefully, so as not to roil the market and cause the market to go down on them before they're done selling. And so they're very careful about that. So know that one of the things that happens in distribution is the volatility increases as you go through time. And in accumulation, the volatility decreases because we have the attribute of absorption. So one of the attributes of absorption is stocks in strong hands, and it tends to cause volatility to decrease. Now, it takes a keen eye to see it, but and so some of the things you'll see widening spread on the declines. You'll see diminishing spread on the rallies, volume drying up. You'll see broadening spread in the declines and volume generally rising. Might be modest at first, larger later. Look at this decline, upthrusting action, upthrust after distribution, and then a very large decline into a sign of weakness. And a sign of weakness is taking out key prior lows and then maybe rallying, maybe just going sideways. But these declines have big volatility in the decline, and volume tends to keep expanding. So those are internal attributes of distribution that we want to always be testing for in our analysis. And both of these schematics have the same characteristics of that attribute. Now, one of the things that's the result of that is that you're going to get, let me see if I can go back to that. I think it's this one, is that you're going to generally have the volatility expanding. Here's your upthrust after distribution. And then look at these big columns of O's in the point and figure chart. Now this is attempting to get dull and quiet, and it does upthrust here. So this is an indication that you were going to get a rally, but then immediately it fails again, and look at the volatility come in on the downside. And so this distribution as a result of this increasing volatility on point and figure charts tends to build distributional count quickly. And that's a really important thing, because when volatility is drying up in accumulation, the counts take longer to build. This is 2019, this is 2022. And this, look how long this accumulation took to build. The CO is in no hurry. They are going to take as long as they need to, and they will check the advance. They will stop buying around the resistance areas, and they will try to do their buying on weakness. And they will take as long as it takes. They have imminent and infinite patience. Where selling, what happens is that other very smart people see the selling starting to happen in the structure, and it starts to get crowded. So there's more and more smart CO types selling their positions, and fewer people out there to buy those positions from them. That is the result of that is volatility. And then look what happens here. Notice this trading range here, downward tilt, very volatile, up, down, up, down, up, down. This is a sign that this instrument is in weak hands. And sure enough, at the conclusion, it just goes down again into the distributional point count right there. And then builds another cause and has another move. And I can show you.
I'm not trying to be perma bulljack, perma bearjack, just charts jack. Just whatever the charts are telling you, that is all I'm good for. That's all I'm here for. And nothing else. I'm not your hype man. You know, I'm not your bear guy telling you to sell.